Hello, everybody. Thank you so much for joining us this afternoon. I'm Molly Maddox on behalf of the Midwest Founders Community, and welcome to our next How To, which is a Founders Community virtual event series that showcases our partners, provides them with a platform to share their areas of expertise among other founders and entrepreneurs. Today, we are once again joined by Jay and John, two attorneys from Godfrey Kahn, who are going to share about terminology and term sheets as the second of our three incredibly informative how-to sessions. As we all know, the startup journey can be daunting, especially when faced with unfamiliar terms, complex agreements. In this session, they're going to break down the basic terms used in venture investments, walk through sample term sheets, and equip you with some additional knowledge and tools that your startup deserves. At Godfrey & Kahn, Jay and John provide high-level service and creative legal solutions for their clients while valuing trust, teamwork, work ethic, integrity, and client success. Once again, we can't wait to learn what they have to share with us today. So without further ado, take it away, Jay and John.
Excellent. Thank you, Molly. So we're going to jump right in. Today, or about a month ago, we talked a lot about different terms and kind of concepts that relate to starting a company, and kind of must things to do with your company. And today, what we're going to talk about is more generally, how companies raise money, and primarily in two different areas. One, John, if you want to go forward one, we're going to talk about a bridge round, or a bridge investment, which is a convertible instrument, which is basically a convertible note or a safe, and then the priced round, and then talk a little about the process and the terms that are used in these. So starting out is the bridge investment documents. We've got the convertible notes and safes. And we'll talk about how these are similar and different. And then I'll just do a public service announcement. A safe is not a note. So you may hear them referred to as safe notes, but it is just a safe, a simple agreement for future equity. So the next slide that we have kind of talks about how quickly the startup kind of investor market has changed. About 10 years ago, all you would see were convertible notes. And then I believe in I can't remember exactly when the simple agreement for future equity the safe was introduced, but little by little that became more of the norm. And then starting in 2020, it just took over, where if someone is using a convertible instrument, it's almost always a safe, especially in the pre-seed, kind of before a priced round. It's often different in later kind of like more mature companies that are doing a true bridge between priced rounds. But as far as for pre-priced round, early stage companies, it's almost universally safes at this point. Though we are starting to see some pushback and a push for more uniform convertible note terms, which may change that a little bit.
Now, just to add to that, there has been some divergence geographically between safes and notes, and I'd still say there's still some geographic discrepancy between what is done on the coasts and what's done in the Midwest, with a higher percentage done in notes in the Midwest still than on the coast. But it's on the pathway that Jay indicated.
So we'll talk about the safe. Are we stuck, John?
Did it work?
There we are. So the SAFE stands for Simple Agreement for Future Equity. And you'll see in the chat that there's a sample, the SAFE agreement that if you want to click on and see what the full document means or looks like. But the safe is used for these kind of pre-seed, pre-priced round where the companies don't quite know how much they're worth, what the valuation would be, but they're willing to put some sort of cap or valuation cap on their kind of what they think they might be worth. The reason that people go about safes are that it's you'll see it's like a couple page document. It's fairly simple. And in theory, it should be a much more cost efficient way to raise money. I've seen them anywhere from a couple $100,000 to millions of dollars. But it seems like anywhere where you start getting over the 2, at least in the Midwest, and probably closer to 3 or 4 million on the coast. Once you get above that, people tend to flip to a priced round where you're actually issuing preferred stock. So a safe is a contractual right to receive equity or stock on the closing of a future issuance of stock. So the idea is that what we're doing is we don't know exactly what the future is going to hold, but the company is going to say, if you give me money now, and in the future we raise money, we'll give you shares, and we'll give you the amount of shares based on a discount. Meaning, all right, if we're issuing shares of preferred stock in the future for $1 a share, and your safe has a 20% discount, then instead of paying $1 per share, your safe will convert at 80 cents per share. So you'd get a little bit more because you're going in early when it's less certain. The other way that they do it is a valuation cap, meaning that what we'll do is if the valuation cap is $5 million and in the future you raise money and you're able to get a $10 million valuation, you as a safe holder, the safe investor, would convert as if it's a $5 million. So they would get, in that sense, instead of a $10 million valuation, so they'd get almost double the amount of shares. But it depends on the number of shares outstanding to do the math on the exact number of shares that the investor would get. We'll kind of go back and forth between the safe and the convertible note, but typically, there's a couple of different things that could happen on a safe. You issue shares in the future of a preferred stock round, and then the safe converts. The company could sell before the safe converts. And generally what the safe does is it says, all right, you'll get the greater of your money back in a sale, or what you would get is if you converted to common stock right before the sale based on the terms of the safe. And then generally I guess the last thing is that if for some reason the company would go out of business or dissolve before, they typically get their money back in that scenario. Safes have generally they do not, or ideally there's no change to the form safe. There's Y Combinator is the accelerator that developed the safe, and they have it right on their website. So if you search Y Combinator safe forms, you can find them right on the website. There's a discount only safe, a valuation cap only safe, and then I think I know it's common in the Midwest to see both this discount and valuation cap, but I think I've seen it from all over the coasts as well. So it's not just a Midwest thing. They used to have it on their website, and they for whatever reason they removed it a couple of years ago. But you can find it, and almost all lawyers have that copy still.
And the form that is in the comments is a is both a discount and a cap.
Yeah. Let's see. Any special rights that an investor would ask for are typically provided in a side letter. So things that people might ask for, most favored nation. So if you offer as a company better terms to any investor, the investor might ask for those terms, the right to those terms. They might ask for information rights. They might ask for the right to a board observer seat, or they might ask for kind of the pro rata rights for future issuances. And then sometimes big corporate venture investors might ask for even more things. But as a founder, you really want to be careful about how many side letters you enter into, because sometimes side letters, if you're not careful, have no termination, and they can be outstanding forever.
Jay, do you want to mention the pre versus post?
Sure. Yeah. I don't remember the date when this changed, but before, let's call it 2018, the Y Combinator safe was on a pre-money valuation cap, which meant that when the safes converted, they all kind of diluted each other. And so investors had no way of knowing exactly how many, like what ownership percentage they had before a priced round. And the founders didn't know either until it actually converted. They switched this to a post-money safe, post-money calculation, and which is now the norm. And what that does is it makes it very simple from a math formula to figure out, the minimum amount that the company has sold. So the example is if you have an investor that invests $500,000 in a $5 million post-money valuation cap, then they've just bought 10% of the company, because you're able to divide 500,000 by 5 million, and that gives you the exact amount that the company has sold off. And then that gets diluted by the new preferred shares, but it does allow you to figure out exactly what you've sold. And we've seen kind of horror stories where founders don't quite understand how these safes work. So I've seen examples where founders have sold 50% of the company for $100,000, without realizing that a $200,000 valuation cap, if you raise 100,000, you've just sold half the company. And those type of things can, just ruin everything for everyone. Anything to add, John?
Well, just you're right that the post money has kind of become the norm by virtue of it being the form that's publicly out there. But I would say the majority of the deals that I see still are a pre-money cap document. So I think the form that we shared in the chat is a pre-money form. And I think, but in any case, it's important to understand the distinction and have someone really walk through the founder needs to have somebody walk through the implications of doing a pre-money versus a post, so they understand what they're getting into, both the investor and the company.
Got it. Yeah, from a founder perspective, the pre-money is way better. You are less diluted, but from an investor's perspective, a company can just keep issuing more and more safes, diluting each other, without anyone really knowing what they're getting. So these are pros and cons, I guess, more from an investor's perspective. So pro, well, or maybe from the company. So there's no maturity date to manage. They can sit out there forever. There's not many terms to negotiate. It's typically just valuation cap, discount, potentially whether there's going to be a kicker on a sale as opposed to just money back or as converted. And then there's no kind of interest income to worry about or consider. The cons, from an investor perspective, there's no maturity date. So there's no kind of like forced discussion at the end of a maturity date that the convertible note would have. And then, it's possible that a safe could, like a company, especially today with the efficiencies that some founders are able to have with using AI, using different offshore resources, that they could raise money via safe and not need to raise again. And so then these safes are just sitting out. Now the post-money safe addresses this, where it's treated basically as preferred stock, and if there's dividends, the company has to give dividends to the safe holders, but the safe holders do not have voting rights. They are not owed fiduciary duties. There's there's things that aren't great about just having it sit out forever. And because a safe is not debt, they don't have a preference to stockholders. The language in the new post-money safes put the safe holders on par with preferred stock. However, typically, if there's a dissolution, there's not really material assets in these type of scenarios. And that's the pros and cons of safes.
All right. So that, as Jay mentioned, the primary alternative for a convertible instrument to a safe is a convertible note. In the chat, Jay added a copy of a term sheet that comes from the Angel Capital Association that they produced sometime last year, I think.
Just June of this year.
June of this year. And it's just a sample, but it has the primary terms that you would see in a convertible note. And often, I'd say somewhat regularly, you see a term sheet for a note. Sometimes, like a safe, you just see the note itself. But that gives you something to look at in terms of fleshed out some of the terms we're going to walk through here. Similar to a safe, the size of the round ranges to something a couple $100,000 to something much larger than that. Obviously, this is pre or in between priced rounds. So the dollar amount is generally smaller than you'd see in a priced round. Like any note, there's going to be a principal amount, which is the face value, the amount that's loaned. There's going to be an interest on it. The interest rate varies. We see anything from somewhere like 5% to 10%. Commonly, that 6% figure seems to be pretty normal. There's a maturity date on the note. So something happens in a future date. The investors can either demand payment or they can choose to convert, depends on how the note is drafted. And just like any other indebtedness, it is senior to the rights and liquidity of shareholders in the event of liquidation of the company. So it gets paid pari passu with other creditors other than secured creditors. The notes will have details on what triggers a conversion of the note to stock. And the most common provision would be a qualified financing. So a financing of a minimum dollar amount into some class of stock of the company. And when that happens, the investor, the holder of the note, doesn't have an option to convert. They're essentially forced to convert into the stock in that financing. And it's going to be based upon the valuation, cap, discount, whatever is in the note. You could have a non-qualified financing trigger event. Often that's at the option of the holder. So if you have a financing that's less than the minimum for a qualified financing, but there is a stock issuance, oftentimes the company will have an obligation to notify the note holder of that, and the note holder or a majority of the note holders may have an option to convert in that situation. And in the event the company is sold while the note is outstanding, the way it ends up normally is that there's a greater of concept. You get your money back plus interest, or you convert at the cap. Sometimes that's the default is you're going to get paid back, but the holder can choose to convert. Depends on how it's drafted. And then again, at the maturity date, the note holder may have an option to convert at that time. Just like a safe, you can have a pre-money note or a post-money note in terms of the valuation cap, and a construct similarly apply. And trying to determine what you actually own can be difficult if it's a pre-money safe. But I would say that the majority of safes or majority of notes I see are definitely going to be your pre-money variety. Often there is both a cap and a discount, so you get the better price as an investor. In terms of the documentation and what's in there, sometimes you have a note purchase agreement and then kind of a short note that goes along with that. Sometimes it's just a note. In either case, they're going to largely contain the same terms, and there's going to be, just like in a safe, some level of representations and warranties by the company and some from the investor. These, just like a safe, the reps on either side are generally pretty limited, authority, etc. But sometimes that's negotiated. A unique thing on a note is, because there is interest, the interest, whether or not it's ever paid, it is actually taxable to the holder of the note. And technically it's supposed to be reported on an annual basis, even though it's not being paid on ever, perhaps. It's supposed to be reported annually. And in the event that the note converts, the interest also converts in most cases. And even though they're not receiving cash for that interest amount is taxable at the time of conversion to the holder. And sometimes we do see in a note, I'd say more than we see in a safe, that there is kind of a bonus payout on that greater of construct upon a sale. So it's not only interest plus principal, but it might be interest plus 1.5 times principal or 2 times principal, which makes that threshold to decide that you want to convert to stock at that time less likely. This chart talks about the comparison between a convertible note and a safe. We've gone over most of this, but just quick recap. They both have a principal or face value. There's interest on the note, not in a safe. You got a maturity date in a note. Conversion generally is similar, or you can have similar terms. Since there is no maturity date, you're not going to have in a safe conversion option on maturity. And there's a similar priority between a note and a safe upon liquidation of the company, in that they're both senior to shareholders. However, with a safe, you're subordinate to creditors. In a case of a note, you're per passu with unsecured creditors. All right, priced rounds. So this is where the action's at. With a lot of the deals that we work on, there is a sample term sheet that was in the chat. That is the NVCA form, or I think it's a prior NVCA form. It gets updated every once in a while. It does have some annotations on it, which can be helpful for you if you're trying to understand what the different terms are. The NVCA, or National Venture Capital Association, has kind of set the standard for priced round documents. So they have a set of published forms that have become the norm in these deals, and both their term sheet and their underlying documents for the round itself are often used as a benchmark by the lawyers and the principals on either side. First thing we do when we get a draft of a term sheet or a set of documents is to run a red line against the NVCA form, so we got to understand what they changed. And it kind of sets a bar for the negotiations. You can have price rounds with anything with common stock. You can have the norm is preferred stock, but it can be common stock. You can do a price round with an LLC and issue units, whether common units or preferred units. Since preferred stock's kind of the norm, that's what the forms are set up for. It most commonly is what we see, but they can be modified for different types of equity. I failed to mention there that there are other forms. That NVCA is not the only forms out there. They're just the ones we see most often. There are Series Seed forms there's a couple different parties that have published those types of forms. And those are used kind of that first priced round before an A round. And it's the documents, there's a little less documentation involved, but similar concepts. In a price round, you can have multiple closings or a single close. In the case of a price round, you're going to have all the equity or the convertible instruments will generally convert at the time of the first close, along with the new money coming in. And you'll see that oftentimes there's a time period in which the company has to issue additional preferred stock. So maybe 180 days, 120 days post the initial closing, where they can do additional closings to fill out the round. Generally, the price that you see in a term sheet and in the documents is calculated on a pre-money basis, although not always, but commonly pre-money. It's negotiated whether a incentive pool is in the pre-money or the post-money. So whether it dilutes the existing investors or dilutes everyone. Often those pool sizes range from 10 to 15%, varies on both sides. And sometimes you will see the lead investor in the round. So the guy or the fund or the family office or whoever's leading the round may negotiate some benefits for them that the other investors do not receive. For example, the lead investor may negotiate that they get reimbursed their legal fees, or maybe they get a warrant right that someone else, a smaller investor, does not get. And generally that's given because they're the ones that are taking the time and effort to do a lot of the diligence, negotiation, etc. So there is often a benefit there to the lead. One of the principal terms that's negotiated is the liquidation preference on the preferred stock. whether it's going to be participating or non-participating. The norm, and I think it's 95+% of deals that are done these days are 1x non-participating. What that means is that if the company sold, the holders of preferred stock get a greater of either their money back or what they would get if they were to convert to common stock. So it kind of sets a bar and a cliff there for the common to get anything. Depends on what the sale price is in the company at that time. You can have dividends on preferred stock, as you can imagine. That also can increase that floor on that 1x participating. You might have 1x participating plus accrued unpaid dividends, which could have say a 7% percentage rate on the investment amount that can accrue and kind of increase the size of that cliff, the size of that hurdle before the common participate. I'd say in the current environment, the number of deals we see with dividends has increased, although it's not in all deals. Continuing on kind of the primary terms in priced rounds, the investors will negotiate for some level of veto rights on actions by the company. So actions that the company can't take without approval of the investors or a majority of the preferred stockholders by share count. Those are often set forth for shareholder approval rights in the certificate of incorporation, which is a publicly filed document. There's often another set, or can be another set, in the investor rights agreement, which is one of the shareholders agreements. Often that's drafted to say that the company can't take a certain action without approval of the board, which approval must include a preferred director or more than one preferred director. Anti-dilution provisions are set forth in the certificate of incorporation. There's two primary constructs there, full ratchet versus weighted average. And full ratchet means that if there's a subsequent round at a lower price, the prior investors are treated as though they also paid that price in the round. So they get a benefit on their conversion rate. That's a pretty significant, it can be pretty significant. Weighted average is somewhere in the middle. So it is a calculation based on the size of the round, the value of the company, et cetera, that gives them some benefit to their conversion ratio, but not nearly as much as a full ratchet. Weighted average is in every deal these days.
98, 99%.
Yeah.
So if you see full ratchet, run.
Exactly. Preemptive rights is another term that's in the investor rights agreement that may be available to all investors or only those that invest a certain amount. That's the ability to participate in future offerings. Sometimes you see redemption rights. So if the stock is still out, the preferred still outstanding at a certain point, say 5-7 years out, the investor or majority of the holders of preferred may have the ability to force the company to buy them out at a stated price or at a appraised price. You often see that with fund investors who want some ability to force liquidity events, given they have a stated fund life.
But mostly later stage. It's not a very common seed, like first round or even second round.
Definitely. Registration rights is the ability to have the shares held by the investors available to get liquidity in the event of an IPO or to force an IPO. You again see those more in later rounds, but sometimes they're done from the outset. It is about 20 pages of words, and it's often not necessary when you're doing a first or second round. Then in the documents, the board makeup is negotiated and outlined usually in quite detail. The preferred investors often will have a representation on the board, and you may have a 3-person board, 5-person board, 7-person board, and the documents will detail out who's got the ability to appoint each person on the board. All right.
So I guess say that everything that John just went through is a lot. And if if you're a founder and you're raising money and it's your first time through this, there are a lot of resources that if for whatever reason this is something that's super interesting to you, there's a book, Venture Deals, that goes through all of these terms in great detail and would give you a ton of ammunition for negotiating. There's also a ton of articles. Otherwise, what I typically do with first-time founders is we set up a call and we go through all the points, and we talk through it and figure out what's important to them and what's not. Trying to focus on the big things, control and economics, and then but generally investors, everyone's more or less aligned with what's kind of standard and normal. So usually we're not negotiating with kind of way out there unique things, but it happens. For the transaction, okay, this is a slide about what to do when you're ready to start, when you want to raise money. So whether it's a convertible note or a safe offering or an equity offering, you kind of usually start with a term sheet. And when I say term sheet for the notes in the safe, the term sheet might just be some bullet points that you have in your head of, all right, this is how much I'm raising, this is the valuation cap or discount. For the equity offering, it might be a more fulsome term sheet, but it's really used to begin the conversation with investors about kind of what the economic terms of what you're doing are. If you do sign a term sheet, those are typically non-binding. However, in this industry or the environment, typically it's hard to change off of what is agreed in a term sheet. So I'm working with a founder where we're hoping to close on a price round in the next day or two. He negotiated a term sheet with the venture firm before involving any counsel, and then once kind of explained some of the terms that were in the term sheet, didn't want to go forward with those anymore, and just didn't have luck changing the investor's mind. But I think if he would have kind of pushed on those issues before signing the term sheet, the investor probably would have gone along with the terms that he wanted. So typically after a term sheet, the founders, you'll work with your legal counsel to prepare kind of the main documents. Those will go back and forth with the lead investor and kind of finalize. In the meantime, there's a whole bunch of ancillary documents. So consents, certificates, resolutions, if there's a price round or some notes, you'll do a disclosure schedule. So there's kind of, if any of the representations and warranties that the company's making aren't true or require to list out contracts or other items, you'll prepare that. Meanwhile, the investor, or typically the lead investor, will be doing some sort of due diligence on the company. They'll be confirming your capitalization, your corporate structure, your potentially, if you have any material contracts with like a top customer or top vendor, they'll want to see all IP belongs to the company that you're using or licensing, so that all IP assignments are in place, that you have written agreements with all contractors, and they'll kind of like check off a lot of the things that we talked about last month to make sure that the company has done those things correctly. They'll be, depending on, like if it's a priced round, depending on how many convertible notes or safes are outstanding, there's typically a kind of a balancing act that happens where you finalize all the main documents with the lead investor, then you send around to everyone that's an existing investor to, kind of give them a day or two or three to review. But meanwhile, you have to collect signature pages from everyone in order to close, because you want to make sure that everyone's agreed to, like, they've already agreed to sign the documents, but you want to make sure that they sign them, that they're on the hook for all the new shareholder documents. After that's done, typically the startup will file what's called a Form D, which needs to be filed with the SEC within 15 days. And then we'll do state level blue sky securities filings in the states that the investors are residing in. And as John said on the equity offering, typically there's some sort of period of time where the company can do additional closings after that initial closing. But this process is a lot of just herding cats and making sure everyone's aligned. We typically do it with some sort of checklist process, and try to make sure that everyone is informed and clear on what's happening. But inevitably you're trying to get everyone aligned and signing things as quickly as possible so that you can close, get money, and move on to building. Anything to add, John?
No, you did amazing job, Jay.
Thanks. I mean, we talked about this a little bit, I believe, last month, but the most common startup tax entity is a C corp. It's definitely possible to be an S corp, but you can't have multiple classes of stocks. It makes it more difficult to do some incentive equity programs, and you can't have non-individuals or any foreign individuals or entities as shareholders. So typically the S corp is out. And then partnerships, whether it's an LLC or otherwise taxed as a partnership, are also uncommon, given that most investors don't want to have they don't want to have to wait for K1s and have the tax attributes kind of flow through to them. The reason that the C corps are so powerful are a couple of reasons. One is this 1202 gain exclusion. So it's a federal exclusion of long-term capital gain upon a sale of a qualified small business stock. So as long as the company fits a certain requirement, so a 5-year holding requirement for investors, they're able to exclude the greater of $10 million or 10 times their stock basis. And that as long as the corporation kind of fits within the criteria. So they have to have less than $50 million in gross assets at the time of issuance. 80% of their assets must be used in the qualified active business. And then there's exclusions for some businesses like professional services, so a law firm when qualify, finance, banking, hotels, and restaurants. And then in Wisconsin, there's a tax credit program called the Qualified New Business Venture program. And if a company is certified as a qualified new business venture, or you'll hear QNBV, their investors can qualify for a 25% tax credit available to offset Wisconsin income tax. So the qualifications to be a QNBV, operating less than 10 years, have less than 100 employees, headquartered in Wisconsin, with at least 51% of employees here in Wisconsin. And then also excludes some businesses like real estate, insurance, banking, professional services, leisure, hospitality, transportation, and construction.
And while you do have to be headquartered in Wisconsin, you don't have to be a Wisconsin entity. You can be a Delaware entity and still qualify as long as your headquarters are in Wisconsin. And then in terms of the entity structure, sometimes an entity when it takes on a convertible instrument, it may be a partnership, it may be an LLC taxed as a partnership at that time. But in connection with the price round, it may convert to a C Corp. So then the convertible instrument will convert to stock of the C Corp. And that often happens simultaneously with the new investment. All right, there's a lot of terms here, some of which we kind of covered and some of which we didn't. I feel like we've thrown a lot of information out already. Maybe we touch on a couple of these. The lead investor, so often that's the party that helps negotiate the terms with the company. They may get some of those benefits we talked about, but others involved in the deal are often referred to as co-investors. They may do some negotiation, some diligence, but they're largely going to follow the terms negotiated by the lead investor. They're usually investing a smaller dollar amount than the lead investor. Some deals don't have a lead investor. We refer to those as syndicated deals. Sometimes in that case, usually the company actually sets the terms and proposes them to a group of similarly situated investors who would then, as a group, invest in the company, generally on the terms that the company sets, or choose not to invest. We touched on the securities laws. We should stress the importance of securities laws. There's a reference there to accredited investors. And we generally encourage people only to allow participation in an issuance of securities by accredited investors. There are some exceptions to that, but that's the general rule we would recommend you follow. And we refer to the cliff. You often hear that term. The cliff is that liquidation preference that the preferred has before the common get anything in a future sale. So that's a commonly used term. Anything else, Jay?
No, I was just going to say with securities laws, I mean, the default is that anytime you sell equity or debt, the convertible debt, that's a security. So you either have to register with the regulatory body, SEC, and the state equivalent where you're issuing it, or have an exemption from registration. And so the reason that we recommend only selling to accredited investors and not, only selling to accredited investors is the typical exemptions that startups use are 506B and 506C. If you do 506B, which is the most common one, you can't generally solicit, meaning you can't kind of, blast it out on your Twitter or LinkedIn. You can only go to people you have pre-existing relationships with, or you have introductions to, and you can only sell to accredited investors or up to a certain number of non-accredited. But if you do to the non-accredited, your disclosure requirements are like massively more, and it's a real, I would say, a burden for most companies to comply with. Or the 506C is you can generally solicit, blast it out as much as you want, but then you can only sell to accredited investors. And there's platforms that, crowdfunding is a whole nother, topic, but so we won't get into that. But, there are ways to issue to non-accredited investors, but almost every time we go over how that would work with founders, they tend to not go for it.
That is the end of our stated presentation, but we are happy to take any questions, whether verbally or in the chat.
Hey, John and Jay, I have a question. As a founder, is it preferred to do the syndication route rather than having a lead investor?
It's a good question. So there's pros and cons to going about that in different. So I think that generally my experience is that when a founder has a lead investor, they tend to have it tends to go easier for them, because once there's a lead investor, any sort of follow-on investors typically feel more comfortable without doing diligence, without kind of putting a ton of thought into the process. They might review things to make sure it makes sense for them, but generally they're trusting the lead venture investor for doing the work, doing the negotiation, and making sure that there's kind of terms that are market. When it's a syndicate, in all reality, it's the founder and the company setting the terms and trying to find a critical mass of investors that kind of will go along with that. So then it really depends, all right, who is in this syndicate? Are you comfortable? Are you confident that your terms kind of make sense and that people are, generally going to be okay with them? How much time do you want to dedicate to responding to each and every, kind of question and diligence response? If every $100,000 or $200,000 investor thinks that they are the quasi lead investor, your work might be more difficult than if you had one lead investor and a bunch of others following on. But I've worked with plenty of founders that, for whatever reason, weren't able to find that lead investor, and they made the syndication work. So it's definitely a strategy, but I don't think I would say it's like better or worse. It's just you have to be aware of kind of what you're getting into, and maybe be more organized on the front end, making sure that you have a well-organized data set so that you can give any interested investor all right, here's all our information after they're committed, or like more soft committed, and just kind of streamline things so that you can have a more efficient process.
You generally see a syndicated deal at the early stages of a company. So when the dollars involved aren't that immense, and you're kind of going to a group maybe that you have a pre-existing relationship with, or you're asking a relatively small dollar amount from people. Once you get into large dollar amounts, you generally see a lead investor setting the terms, and that can give comfort to co-investors to participate.
Makes sense. Thank you.
And I'll say that I've also had lead investors be a pretty small portion of the actual round size. They're just like, if you can convince someone to step up and set the terms, they're the lead investor, even if they're not putting in 75%, they can put in 30%.
All right, awesome. Thank you.
Any other questions? Looks like you guys added the LinkedIn information and a link to the firm's website. Thank you. So you know how to get a hold of us. If there's any follow-up questions, feel free to reach out. Thank you all for attending.